Live. I am the SmallCapSteve. We got a great guest today. We got Richard Laterman joining us from ReSolve Asset Management. The Fed's they're coming out with some forecasts today, this afternoon. Pretty excited about that. I don't know what's going to happen, but probably what normally happens, which is a whole lot of nothing. It is Wednesday, March 17th. Buckle up. Let's get started. Richard, thanks so much for joining us today.
Good to be with you guys. Thanks for having me.
So we were talking a little bit beforehand. Your background, you actually learned your sort of equity trading, equity analysis, all that fun stuff in Brazil.
That's right.
So if we can start off at the top, I know nothing about the equity markets in Brazil. What's the story with Brazil in terms of, like, I assume that there's a stock exchange.
The Bovespa is the big stock exchange, and the equity index, the main one, is the Ibovespa. And I began my career down in Brazil. I was born and raised in Rio, and started as a trader, and moved on from the sell side to the buy side as my career progressed, and focused exclusively in the Brazilian equity market. And then I eventually moved to Canada and are doing the systematic global macro space right now.
Okay, well, very, very timely. All of this stuff that's going on right now with the Fed and all these different facilities and money printing. Now we're talking yield curve control. This all must be pretty exciting for you, if not a little dangerous for the world, for somebody who analyzes the stuff for a living. I'm assuming that you've had a lot of late nights tossing and turning in bed thinking about the outcomes that the Fed may be causing.
Yeah, we don't lose a whole lot of sleep over this stuff at ReSolve. We've kind of established our systems, and we've chosen to be systematic because we don't believe that we should be trusting our guts for decision making, especially when bullets are flying over our heads and when you're going through such a different time in history, and which could potentially be a transition or a paradigm shift into a new sort of regime. But we have our rules in the way that we manage our portfolios, and we focus on the best beta out there, and we can talk a little bit about that, which is the risk parity portfolio. And we also have our pure alpha programs, which are based on some machine learning and edges that are tailored to specific markets, all in the future space, which kind of allows you to actually access a very broad range of global markets. But not a whole lot of tossing and turning. I mean, I'm interested in all this global macro narrative, and particularly what comes out of the U.S. and the Fed, for obvious reasons given their importance globally. But that's a lot when it comes to, I use that a lot for my conversations. I do business development and writing at ReSolve. So the weaving a narrative regarding what's going on in the world helps people make sense. That, I mean, we're, as humans, we lean on narrative for making sense of the world. And so that feeds back into a lot of the conversations that I have on the business development side of things. And so that's where a lot of my interest lies.
Yeah, just watching CNBC lately, it's like you watch Fast Money and it's like the 10-year, it's up 15 basis points. What's going to happen? And everybody has these like 2-minute sound bites. And then it leaves me tossing and turning at night, because I mean, Jay and I, we are micro cap. Like, let's go rip apart accounting notes and understand when shares are coming free, try to understand the cash flow statement, all that fun stuff. And now it's like, we know that we're trying to steer a canoe with like 20-foot waves coming at us. So we're really focusing now and trying to understand where all these inflows are coming from and what the variables mean. And the strange thing is we do have a lot of people on our show and we ask them these questions about the 10-year and the 20-year and all that fun stuff. And it feels like we don't really get a lot of good answers of like why should we care so much about the 10-year? What's your answer to that?
I mean, the 10-year is typically seen as the most important variable in finance, depending on who you ask, or at least one of the most important. And it's because it is the price of money for the most important economy on the planet. So, and what I mean by price of money is it becomes the discount rate for models if you're focusing on the equity space. And it is also the opportunity cost, the prime opportunity cost metric for assets across the globe. And that is, I mean, that's kind of the main reason. I mean, the Fed typically controls the short end of the yield curve, which is the Fed fund rate, the really short money, and the market dictates where they want the 10-year to be and the 30-year. And notice that I said typically, because obviously with what has been going on in terms of the monetary policies, the unorthodox policies that have come down the pipe since the great financial crisis in 08, 09, that's changed quite a bit. We've seen not only quantitative easing, but then Operation Twist, which is when the Fed is buying the longer end of the curve. And so that is, they're trying to dictate a little bit where that 10 or 30-year can go. And the big topic right now is yield curve control, which is Operation Twist taken to its extreme, right? So,
so my understanding of Operation Twist is that they're selling the short end and they're buying up the long end. And with all this talk of yield curve control, what we're talking about now is just straight up effectively printing money and just buying up the whole curve. Is that accurate?
It's buying up the whole curve for sure. And what they would be looking to achieve is keep the curve from steepening too far out. I mean, basically right now, what the market is saying is, yeah, I actually believe the Fed might leave interest rates low for the foreseeable future, especially the short-term rates. And what might that imply for inflation? Because we are seeing right now, this is the big question right now, right? How is inflation manifesting? Is inflation actually going to manifest in any meaningful way? Is it going to be above 2%, which the Fed has now said they're comfortable with because they're actually targeting an average as opposed to a specific year by year target. And they are saying they're going to be, keeping rates lower for longer and that sort of thing. And so what the market is saying right now is, yeah, I actually think the Fed is going to keep that, but I think inflation might manifest and it might be on for longer. And so I want more returns. So the market is demanding higher returns as you go out on the duration curve because of that.
Got it.
So the one thing I have to ask, you've kind of got into a bit here. Macroeconomics to me is an extremely broad term. So when you say that you're the macro guy for the team, what specifically are you looking at? Can you get into a bit more granular on that and actually provide some details there?
Yeah, for sure. And let me just caveat, I'm not the global macro economist at ReSolve. We don't actually have that title there. But yeah, I'm particularly interested in microeconomics. In terms of the variables that I'm looking at, I'm trying to understand from the macro perspective where money is flowing towards and away from. And what you're looking is flows across asset classes in different countries. And so inflation, interest rates, the currencies crosses, those are some of the big variables to be looking at. And obviously right now you have to contend with some of these emerging asset classes. I mean, crypto, the relevance of crypto. Why is this happening right now? Well, it's because there appears to be an exhaustion of the fiat money system, which has been the established system since 1971 when the Bretton Woods system collapsed and the dollar was no longer redeemable against gold. And so that's kind of like, I'm trying to understand the foundations of capital flows on a macro level, so on a global scale.
Okay, so the next question we got to ask you then, and I don't know if you talk about this publicly or not, but where are you forecasting capital flowing over the, say, next couple of years?
So yeah, we don't do any forecasting at ReSolve. What we do is we actually let the market tell us where things are going. And what we know is markets move based on expectations, not so much what is actually going to happen, but just the changes in expectations versus where these expectations might have been a week, a month, a year beforehand. So that shifting expectation typically dictates where capitals are going to be flowing towards. So we're now looking at the potential for rising inflation. We've seen that manifest particularly in the grain space over last year. So even in a year like COVID, when you had the collapse of economic activity, you saw soy and corn rising quite a bit. And in the second half of the year, you also seen energy prices rising tremendously, and they've continued to rise into this year. And we can get into all the specifics about, supply and demand and the particular idiosyncrasies of these markets. I mean, energy, the crude oil market is perhaps one of these other major variables that I would be looking for. And it's because it is such an important proxy for the price of energy all over the world. And, we need energy for everything, whether it's agriculture uses or logistics and transportation and things like that. And so that is a particular important variable to watch because of how that, if the cost of crude oil continues to rise, if the price continues to rise, it has significant trickle down and knock-on effects across the economy.
So my understanding is essentially you're gauging sentiment throughout at a macro level rather than a micro level like Steve and I more commonly do.
Yeah, that's right. Yeah. And what we're allowing is for the market to tell us where money is flowing away from and towards. And what that implies, I mean, what I think gets lost a lot of times and there's quite a bit of nuance around this, is the idea that capital flows happen sometimes for reasons that we don't exactly understand. And then the narrative chases that flow. And people are trying to, and oftentimes that will become a self-fulfilling prophecy, right? The narrative feeds back into the price dynamics, and that flow will continue into that loop. But oftentimes you see news stories written about a particular price dislocation in the market, and you can tell that the reporter there, I mean, he's trying to do his best. He doesn't exactly know why those prices have moved. And so he's reaching, and he'll call a couple of asset managers and they'll give him whatever reason. Oftentimes these guys don't know either. Sometimes the flow just happens because they haven't. You have price insensitive buyers and sellers all the time in markets because they're either hedging or because they had to unload a particular position. When you're dealing in the commodity space, you have producers, and they're looking to hedge their positions as well. And so it's a really interesting multi-dimensional game.
So what are the metrics that are like the variables that you're watching to measure these flows? I'm sure that when you wake up in the morning and you sit down at your computer, you got your coffee and you're staring at your screen, what are those first handful of numbers you're looking at to try to give you a sense of what's going on to measure those flows?
Well, to be perfectly honest with you, I'm not doing any of that. We have a bunch of systems that we've established to allow us to gauge sentiment. A lot of it is based on price movements and averages and things like that. But we're also looking at capital flows, and our system will allow us to actually put in a number of different variables that some people might describe as alternative data, for instance. I mean, I don't know how much you guys have looked into this topic, but there's been a rise in some of these narratives, which appear to be quite compelling, even though there isn't quite so much data to back it up. But there is circumstantial evidence about price insensitive buyers in the ETF space, for instance, and how that tail is wagging the market dog, and why the market appears to be divorced from fundamentals, that sort of thing. And oftentimes good news is bad news because of, what we've seen recently, economic activity picking up and the market's starting to freak out about what that's going to entail for inflation and rates down the road. So it is quite an interesting and reflexive game at that. So not only the insensitive pricing, the insensitive flows in the equity space, but you can think about market makers in the option space as well. And there's a quote unquote hidden order book because these guys need to be constantly hedging their positions. And so oftentimes they are impacting markets in a very meaningful way. And we've seen that recently with the GameStop and the Reddit crowd and all that impact in some of these smaller and less liquid names. But these are some of the dynamics that a lot of people don't really understand at a surface level, and you have to go a few levels down to really start digging into why these flows are happening.
Do you guys look at social media at all? I know that I've heard rumors of there's like hedge funds in New York that have sort of like scrapers that look at what's being tweeted about or what's showing up on Reddit, and they try to front run retail. You guys don't look at any of that?
We don't do any of that particularly, but there are a number of different asset managers out there, and I've chatted with a couple of them that look at things like NLP, natural language processing, and there have been for many years now bots that are looking and scraping the Bloomberg terminals and many other of these news terminals that are looking to see what kind of news are coming out, what did the Fed say, if the Fed governor or one of the regional presidents has said anything meaningful that will change expectations, and we'll trade on those things. So yeah, those definitely do exist, but we don't really do any of that.
I think I actually read a Forbes article about how it's actually changing how news releases are written because all these bots are effectively just scrolling through Edgar, scanning and trading on that data. So it doesn't surprise me by any means that social media would now be encountered with it.
So go ahead, Jay.
Go ahead. No.
Okay, so my question for you then is, so you guys have these systems that help you look at the flows. What are the variables that sort of drive your system? Are you guys looking at equities? Are you looking at commodity prices? What's the like key variables that you're using to sort of evaluate those flows?
Right. Okay. So we can get into a little bit of the specifics. So on the beta side of things, which is risk parity to us, you have to start from, we have this framework where your starting point is to say, okay, what if I can admit to myself that I don't know the future, right? What if I can admit to myself that having this 60-40 so-called balanced portfolio is actually a manifestation of recency bias and this belief that equities are going to continue to rise into the future, especially because everyone believes that the Fed has their back. Mm-hmm. And so when you can actually take a step back and look at a broader term of history and you say, okay, there are numerous times, sometimes decade long, when equities and bonds don't really provide you with any meaningful returns. What would you own? And the answer to that for us is risk parity. So we're actually looking at global equity indices, global sovereign bonds, no credit, commodities, and then currencies when you layer in some of the alpha edges. But to stay in just the risk parity framework for a second, thinking about what drives markets is the changes in expectations, right? And those changes in expectation really manifest under two specific axes, inflation and growth, and they can be positive or negative shocks. And we know which asset classes do well in any one of these regimes. The tougher part is to predict them consistently. So we believe in starting with that broader investable universe of global asset classes. And then from there, you have your diversification. But how are you assembling that portfolio? And what we don't want is to let the maniacs take over the asylum, so to speak. And so what we do is we create balance, and that's risk balance. So a 60-40 so-called balanced portfolio actually has 90% of its risk dominated by equities, because equities are on average 4 times as volatile as bonds. So in the risk parity framework, you focus on global diversification and risk balance. So that is kind of the approach. So what we're looking at is volatility and correlations across these asset classes. And as always, the devil's in the detail, and there's quite a bit of nuance. There's many different ways that you can deploy a risk parity strategy. We focus on one that is constantly updating our priors and our measures for volatility and correlations. And we're not reverting back to any specific predetermined weights across these asset classes, which are based on long-term volatility and correlation. So we believe in what's called a pro-cyclical approach as opposed to an anti-cyclical one. And so that's kind of the risk parity approach, creating diversity and balance. We joke, we say it's the Hippocratic oath of portfolios. It's the do no harm. It's the starting point. It's what we believe is the natural starting point for all portfolios. And then on top of that, we can layer on active bets and edges depending on your expertise and how you might manifest those views.
Okay, so you guys have two ETFs here I see on your website. One is the adaptive asset allocation. The other is a robust equity momentum index. Let's start with the adaptive asset allocation here. I pulled it up. It looks like it's managed through it's through Horizon. So right. What can you tell us about this?
Yeah, so that is a strategy that has 3 different approaches built into and integrated into one. So the first one is what I was describing earlier, which is the risk parity framework. And it creates this great balance to start with. And the way that we do it, we're also trying to maximize the diversification benefit from it. And when you're in the future space, you're not looking at commodities as a single unit, but you're actually looking at different specific commodities. So you can imagine grains will react differently than energies or livestock or metals, depending on the shock. And so that's kind of the starting point, and we can harvest a rebalancing premium by having so many diverse moving parts and independent bets in the portfolio. On top of that, we layer what is known as a systematic global macro edge. It's kind of a blanket term. It doesn't mean anything, but when you dig deeper, what we mean is we're actually looking at each individual market, and we're trying to understand how each one of these markets react depending on the buy and selling flows. So, how does the trend in corn react to its seasonality, for instance? And when trend is very, very strong in bonds, for instance, and it goes parabolic, there's bound to be some mean reversion and some selling pressure. And so these are some of the things that we're looking at using machine learning.
Okay, so you guys are actually using AI to effectively machine learning to give you these mathematical relationships that tend to exist, I guess, based on probability of when certain things are happening with certain flows, what's going to happen next type thing.
Yeah, that's right. Yeah, we're using machine learning to understand and to tailor specific edges to each individual market. We trade over 70 different futures contracts. And so that's kind of the prediction side of things, quote unquote. And these edges can be turned on and off depending on the market regime. So we're also looking at things like volatility and how markets react under different circumstances in different regimes. And so that's the second leg of that stool. And the third aspect of that is that we talked about the axes of inflation and growth, but there's a third dynamic there, which is liquidity. And oftentimes liquidity dries up in markets, and you have these liquidation phases when people are just selling everything. It's those days. I mean, in March, we had a couple of those, March of last year, when everything was just red, right? Even the winners in your portfolio are being sold because people they need to raise cash because they're getting margin calls, and they're just hitting anything that has a bid there. And what we typically, one of the few alternatives to make money in those circumstances is to be long volatility. So we'll trade the VIX and the V stocks, which is the European VIX, and we'll look at the term structure and the curve and the shape of that curve, and we have the ability to go long volatility in these moments of duress in order to provide a meaningful protection.
Okay, so this is going to be a fun part for us. I don't know what half these things you guys hold are. The Euro Bobble Future EUX. These are you have a ton of exposure to this. What is that?
That is a European a sovereign bond future contract, and that is from a dollar perspective. Yeah, it is currently representing about 65. I can't even see the number.
Yeah. Oh, here I can zoom in a bit.
Yeah,
it says 65.28%.
Right. Yeah. So that's the dollar amount. But when you put on your risk parity goggles and you take it from a contribution of risk to the portfolio, that percentage is a lot lower. Okay,
got it. Okay, and so it looks like you guys. So walk us through what that means. You guys are long bonds, which means that theoretically we want yields to go down because that would mean that the prices of the bonds go up. Would that be accurate?
That is accurate, yes. But we don't necessarily need to be long bonds, and we can actually go short. And we were actually long U.S. Treasuries up until late last year, and then we brought that position all the way down to zero. The funny thing is, the expectations around bonds has been quite negative in the last few months. But we're actually looking at a much longer trend of positive bond trends in the last, call it 30, 40 years. And yeah, right now the expectations have shifted towards, rates are going to be rising. And in the future, I mean, the market is repricing these bonds lower because they're demanding higher rates. But people have been trying to short the German bonds for, I don't know, almost 10 years now, unsuccessfully. In the Japanese market, that has been dubbed the widowmaker trade because it's been, I think, almost 30 years now when people have been trying to unsuccessfully short Japanese bonds. So yeah, these shifting expectations will cause some selling pressure in bonds from time to time. And look, if we do in fact change regimes and we go into secular inflation, which the jury's still out there, I'm not convinced either. I think we can have transient inflation spikes and then moving back to the longer term secular deflation that we've seen. But even if we do, the strategy has the ability to hunker down and bring its position in bonds down to zero and to focus on other asset classes as the flows manifest in them. Okay, got it.
So that's an interesting point. So it sounds like you and again, not making forecasts. You think that we could see a period where we see a bit of a rise in inflation as the economy. We got a lot of pent up demand, all this money that's been injected into the system, but that's going to be short lived, and inflation will kind of go back to its normal levels, if not, hovering on deflation. As we a couple of years down the road when we get a little bit more back to normal. Is that sort of what you're getting at?
Well, it could be, right? I mean, at the end of the day, you have different dynamics pulling inflation upwards and downwards, right? So you do have the rise in the price of grains that feeds into price of livestock as feeder as well. And particularly the energy complex is very important for inflation. with the rise of ESG and things along those lines, you are actually seeing quite a dramatic reduction in the CapEx dollars diverted towards exploration and production in the main oil and gas companies. So what you can expect is in the coming years, you're going to see a much lower supply or capacity, at least in the market. So if that in fact does, if that is the prevailing trend, and if indeed no new capacity is brought in, you could see the price of energy sustaining. And obviously that goes through the highly unstable cartel that is OPEC, where sometimes there's cooperation, but through the years you see them cooperate for a little bit, and then everybody starts to cheat and to produce more oil, and so oil prices tend to come down once again. So oil is a big factor in this picture, but you also have some longer secular trends that are particularly two-pronged, I would say. Technology and the advances in technology and what that has done for the advancements in the production of food and so many other aspects of our lives, and in healthcare as well. And that has allowed prices to come down quite a bit. And the other part is demographic. We are seeing an aging population with low birth rate. And so that is definitely a headwind when it comes to inflation.
Okay. So your staff, I'm interested in what's the background of everybody to be doing portfolio management through machine learning? Or like do you got a bunch of quants behind the scenes, or like what's everybody's background to be managing a portfolio like this?
Yeah, we have a bunch of different quants with varying backgrounds. Everybody codes in the research team, and across the partners, we have guys that are more focused on the research and the quant aspect of the business, and others that know the math, but they also can speak English eloquently to convey some of these, because oftentimes those two skills don't come together. So it helps to have people that can navigate those two worlds. And so yeah, the team, the majority of our 17 strong team is is in the research and operations side of the business. Okay,
cool. There's a lot of questions I could probably get into there, but I think it's going to bore. I'm a former math teacher, so I think that it's going to bore the heck out of our audience if we go there. So we talked about the first ETF. Your other ETF here is the Robust Equity Momentum Index. What can you tell us about that?
Yeah, so that is a tactical equity strategy, right? It has the ability to invest in the S&P or in ACWI-X, which is the All Country World Index X the US, so to focus on global equity markets, emerging markets, or transition into the safety of treasury bonds and cash. Although treasury bonds haven't appeared to be that much of a safe haven in the last few months, but again, in the broader arc of the last few decades, it definitely does have provide a balance to the portfolio. And basically, the idea of that strategy is to say, okay, what are the trends that are manifesting in any one of these markets, and which one of them do I want to invest? But how are we defining trend? Is it the 200-day moving average? Sure, that is one of them. What else can we look at? And so, it's the idea of working with ensemble methods, which is a topic that tends to be quite overlooked in finance, but is very, very popular in domains of knowledge like operations research and things like that, right? It's the idea of being broadly correct as opposed to specifically wrong. So you can take the 200-day moving average, but you can also take the 100-day or the 50-day moving average, and that's just to stay in the moving average realm. And then you can look at absolute trend, risk-adjusted trend, number of days an asset class has been in a particular trend, and you take all those different metrics and you you also take a number of different lookbacks. And so what you end up having is thousands of different sub-strategies, all of them trying to harvest momentum through a slightly different angle. They can be correlated, but they're not perfectly correlated. So there is a diversification benefit to that. And it's kind of the humble approach. I mean, it's to say, I don't know which one of these metrics is going to be the best one going forward. So why don't I use them all? And it's, again, the idea of being broadly correct as opposed to focusing on any one specific metric that could be the next price to book, for instance, to use an example that a lot of people, I'm sure, are more familiar with, which is value investing. But price to book has been the worst performing metric within the value investing framework. So it's kind of the idea of being broad and having the ability to transition and rotate into the broad equity markets that are more favorable at any given point in time.
Okay, so one last question for you here. Today we got the Fed. They're going to come out with their forecast. What's your take on this? You think that we're going to get any big news today?
Yeah, I mean, with the Fed, it's really all about what the market is expecting to hear. And right now, they're expecting to see continued dovishness, and I don't think we're going to see any surprises there. What I think they're looking at particularly is I think it's the dot plot that they call it, but it's when the different members of the FOMC expect rates to rise to start rising. And so I think the median dot right now in that plot is around 2023. And I think market participants are focusing particularly to see if there's going to be any shift there, and if the Fed is now expecting to raise rates sooner or later, given everything that we've been seeing in terms of expectations and inflation, but also some of the other economic numbers. We saw terrible retail sales recently. It was today, I think, or was it yesterday? Anyway, it was the lowest print in the last 30 years, except for the 2000 and 2008 recession numbers. So it was a pretty staggeringly low number. And I think this is sort of one of those things where, bad news is good news, because if the economy is nowhere near in a position to be weaned off all this monetary largesse, then the markets are going to expect the Fed to continue.
Sorry, and I said last question, but
no, go ahead.
How much do you guys think about Biden's talking about a infrastructure bill that everybody's estimating, or not everybody, but many are estimating to be, in that sort of $3 to $4 trillion range. How much do you guys think about these sorts of things? And if you don't, what kind of an impact do you think this has on the market? Do you think that this is already baked in?
Well, our models will pick up on those trends, quote unquote, not because of the narrative, but because if that narrative starts to impact the expectation of prices in, say, the metal space, for instance. So we've seen copper perform particularly well in the last, call it 6 months, perhaps a little longer than that. And so we're not particularly looking at that bill or any kind of news for that matter, but they will manifest, and our models will pick up on the changes in prices. On a sort of personal note, I mean, I think it's going to be very hard for that size of a bill to be passed with the current 50-50 Senate broken up. The vice president does have the final vote, and she can help in some of these votes, but you need a 60 senator majority vote there to get this passed. And they've already used their once a year token that they wouldn't have to use to pass the recent COVID relief bill. That wouldn't require the filibuster-proof majority. So with the current Senate as it is, I think there's going to be the Democrats are going to find a very hard time in getting that passed. Having said that, if they do, I would expect commodities to continue to rise. for sure, particularly in the metal space.
Okay. Well, Richard, thanks so much for taking the time to join us today. This is really helpful for us. We're just, like I said before in sort of the pre-interview, we are small cap, micro cap guys looking at our CDR notes. And this is just such an important time to be able to understand how to navigate these choppy waters. So we really appreciate you taking the time to come on here, and hopefully you'll join us again as we see a whole bunch more developments over the coming quarters.
Yeah, for sure. I'd like that. Thanks for having me. I enjoyed the conversation, and we'll speak soon.
Perfect. Thanks. So Jay, what's going on today in the small cap world?
Oh, small cap world. I think we might actually get a summer this year. I know last year we didn't really have much of a summer at all, solely as a result of the pandemic and everything else, just sending markets wild when you and I both thought that we might be in trouble in terms of our own employment.
Yeah.
But it's definitely starting to slow down. Starting to see a lot of junior mining news as of late, not so much other sectors like cannabis and tech. Even psychedelics have slowed down a lot. So now that drill season has started in most jurisdictions, it's largely dominated by that.
Yeah. So let's start off here. I see that our friends over who don't like us very much because our writer Braden Mack wrote an article kind of
So you're talking about Fans Unite.
Fans Unite. Yeah. So what can you tell us here? So
quick little story this morning. I'll be honest, I don't particularly follow Fans Unite or TGS all that much. However, partnerships always interest me, especially among small caps. Basically, TGS Esports will be incorporating the wagering software produced by Fans Unite on future live events, future live gaming events, and enabling viewers to effectively bet on who they expect to win. It said certain prizes will be offered. They didn't really provide much detail into that. It looks like they've already started integrating the software together. There was a screenshot shown in the actual news release. I didn't think it was all that pertinent to include it in here. But it looks like it might be a nice little partnership. Financial details not provided, as has become standard in the small cap world for whatever reason. But yeah.
So something I'd like to talk about a little bit here that's shaping my world is my good friends over there at Iguana. Is it Stifle or Stiefel?
Sorry, Stiefel.
Apparently they get very like, you better pronounce it right, but then anybody who doesn't work there intentionally pronounces it incorrectly. So there's like these two pronunciations, and and I can never. I'm not from this world, right? So I can never.
I can never remember the proper pronunciation to say that.
And there's a bunch of people with gritted teeth hearing me say that, and a bunch who are laughing because they're the ones who have screwed us up to the point where we don't know what is what anymore. But I tweeted this yesterday here. Stiefel GMP comes out with an initiation report on Iguana, 85-cent price target. Let's pull this graphic up here. I have a copy of the report. I don't know if I should share it. Probably not, and if I get in trouble for that. But this is good. This demonstrates that this is a real company doing real things that has a real firm backing them that's saying, okay, and look, I know it's sell side, and GMP put out a lot of cannabis sell side reports that I think we could poke fun at, but to me, this is a 20-year company that struggled, that's going to quickly become an overnight success. Obviously, I'm biased.
I just love the phrase overnight success because it's just so typical of the world we live in, where it's, oh, these guys came out of nowhere. No, you've been literally building your business for 20 years, right? Same thing with Powerband. I think we talked about this yesterday on the phone, actually. Not to pump Powerband by any means, but I mean, Kelly goes into the office every day and he gets stuff done. He's building his business, and he has been for 15 some years, right? Same thing with Iguana. Justin Holland, the CEO, he's in there slugging it out day in, day out, building this business.
And it's not just Justin. There's a whole team and a whole staff of people who work full time on this business trying to make it work. And when you're talking about Canadian micro caps, Canadian small caps, venture stocks, a lot of these are effectively just shells surrounded by people who are working on 10 other deals. They try to hire groups like us to get us to promote their deal. Meanwhile, we know that it's not their core focus because they see what's going on in the markets. They want more of that action. So they're going, hey guys, help us move this stock. And we're just, no, I want to support companies where there's a whole team that get up every morning and they try to do real things. And hopefully, if we're lucky, we can find a couple early that are going to, achieve the D word. And you know what I'm getting at with the D word?
Go for it. Disruption.
If the home battery becomes a thing, it's going to disrupt the way that the grid works. It's going to disrupt the utility companies. It's the same thing with power band. I mean, they're like, and that's not to say that these are going to work out, guys. This is not investment advice. I'm not a financial advisor. None of that. Okay. But that's the stuff I get excited about. That's the stuff that makes me get out of bed in the morning and want to check up the news, check on the share price, is what developments are there that makes me think that they've got a shot at disrupting the industry they're trying to disrupt. And we're talking about industries with massive TAMs, total addressable markets. So you're exactly right. We've seen it time and time again. Now, look, we're a little bit biased too, because we happen to be in a world where we're surrounded by mining guys. Most of these mining companies are effectively just pieces of real estate put into a publicly traded vehicle with some nice marketing materials and a few promoters around them. And hurrah, we're going to hit the big drill results, and you don't hear from anybody for 3 months. They have a CFO who's working on 30 other files. That's, and quite frankly, that makes sense in those scenarios. But when we see things that are posing as operating businesses that clearly aren't operating businesses, that's honestly the shit that pisses me off. That, like, if I were running the junior exchanges, I would probably have a capitalization requirement to go public and a number of full-time devoted staff that you can prove before I would even let a publicly traded company that's posing as an operating business to even go public.
The most interesting thing for that, I think, now pre-COVID, obviously, just as part of the listing application, someone just shows up. They show up at the head office, or whatever it is. As well as I know that there's probably 30, 40, 50 companies listed on the venture or the CSE that all have the same head office, right down on Burnaby Street or Howe Street or whatever.
And look, that's a great point. And I actually used to operate and own. I started a math school accredited by the Ministry of Education of Ontario. They actually don't like the term accredited. It's supposed to be approved. You have effectively what's a license to operate to issue credits towards an OSSD. Anyways, that's actually something that the Ministry of Education can do if they have a bad feeling about a private school, is they can go in unannounced and take a look. Are there students here showing up every day working on courses? Is this a real school? Is this a real operating business? And quite frankly, our regulators should probably do that more frequently. I would love to see the junior markets. A lot of the stuff I hear about regulation kind of bothers me because it's stuff that you can't regulate. And perhaps like people are going to get pissed off at me for making these comments because now we're all in this work from home mode where, why do we have to be at a physical office sitting down at a desk with pencils and stacks of paper in front of us when we can all be working from home? But there needs to be more tools to actually look at the merit of these micro caps and small caps so that we know that the butcher, the baker, the candlestick maker who happens to hear about a company on SmallCapSteve Live or, CEO.ca or Stockhouse or wherever, that these are real businesses and they are trying to do real things. Nothing pisses me off more than when I see somebody trying to run a micro cap or small cap deal and they're trying to sell shares open market, and the people who are buying those don't even have a chance. That's the shit that really pisses me off, and we see it all the time. And there's ways to monitor these things and prevent them. And I wish that they'd probably spend a little bit more time on that stuff. But sorry, I got all sidetracked here because you're making a very valid point, which is one of the things that and we've been in Power Band is they've been an advertising client on the deep dive. We're tremendously long, far more than they paid us in advertising fees. I can tell you that much, far more. And there's been moments where we wake up and it's like, okay, the share price is down a bit. This is a little like, ooh. But the reality is that we know that people are waking up every morning. They're going to an office, they're working. And that's what I like to see, is that I know that there's people trying to make this thing work. And that makes me feel a lot more comfortable about supporting it via whether we take them on as a coverage client or we are, investing our own money, which in this case, we have a lot of skin in the game.
Absolutely. And I mean, I think for the last few months, that's really become the principle that you and I are focused on is there someone in an office somewhere working on this as we speak, right? Because the last thing I want is to be spending half an hour, 2 hours, 3 hours, whatever it is, writing an article on a company, only to find out that I've actually done more work for that company that day than the company itself did.
That's happened. I've seen like, it was funny yesterday talking to Mitch, I can never pronounce his name, Barukowitz, about he'd have his whole team read a listing statement. And it's like, sometimes we see these companies and I look at the whole management team and like capital markets guys behind the team, and I'm wondering if any of them even looked at the listing statement. Like, did they just pay a lawyer and an accountant to like create this document so that they can just go sell share certificates on the open market? And and I was actually thinking of one name that you and I looked at. We won't mention the symbol, but it's effectively been a disaster. And I remember like you spending a whole day going through the listing statement and then talking to the management team. And we got the sense that none of them had even actually read it or even really knew why they were even like representing the company.
Yeah. I mean, I know to some of our viewers, what we're saying is mind-boggling. The notion that a company can be public and not even hardly be a company. I was talking about this with my father-in-law, I think last week, and he wasn't fully comprehending what I was saying, I don't think. And I mean, no disrespect by that, but the retail or the typical person, the theory goes, if you're a publicly traded company, you're a company where there's people sitting down every day. And I mean, after our years of working in small cap, micro cap, whatever you want to phrase it as, unfortunately, I truly do not think that's true in every single instance out there.
Yeah.
Right.
So,
and I mean, it's disheartening. It truly is.
It is. But I mean, and that's kind of why we maybe need to be a little bit, act like, ambassadors for the market, self-proclaimed ambassadors for the market, because the reality is that investors need to know what's what. And sometimes that's challenging because we got friends that are in deals or we never hear the end of it when we write articles that, throws a little bit of shade on something. But like retail investors, they ought to know the share structure. And it happens to us. Like sometimes companies ask us to invest in stuff and they don't send us anything related to the cap structure. And we know exactly what that means. We know like, hey guys, will you invest in this round at 10 cents? So 10-cent round, you're probably going to make money. And there's no disclosure as to where the rest of the money was raised or if they're doing an acquisition, how much money actually went into that acquisition that they're about to take out. So there's all these little nuances that I think retail investors, and to be clear, I'm not saying that founders and people who put together deals shouldn't be able to make money. They absolutely should. But we see things that are just so egregious, right? Like I'll throw one out right now. I don't care. ACDC, 300 million shares at a penny. It's trading. I don't know what's trading at. Like, I think it hit a high of like 80 cents or around there. Like there's a relatively new company. You gotta be crazy to go buy that open market. It is what it is. But that's stuff that I think, we ought to talk about more with our audience and just sort of look at that and say, if you think that this is a good thing to buy here after, there's that many shares at like, a much less valuation, you've really got to do your homework and feel comfortable with that, because
yeah, and I mean, a lot of people are rolling their eyes right now. I'm certain at what we're saying. However, consider this: all those deals out there are sucking up capital that could be going to proper companies, real companies that are actually out there slaving away day in, day out, working 70, 80, 90 hours a week per person on a team of 20 guys.
Yeah. And
guys, girls, whatever.
And then the money's going to some asshole so he can buy a $12 million house in Vancouver, just sucking it out of our junior and capital markets, when that money could be deployed to, employ people who are then going to go and contribute to the, economy and help make investors money, which is really the whole purpose of the exchange, is to support companies and create vehicles for investors to do so, not to be wealth transfer vehicles that just take money from retail investors and put them in the pockets of the deal guys, which is something that gets me really fired up, because it's really disheartening when we see this stuff. And I know that in large part, when you first started the deep dive, you were covering these things. And a lot of times, it's as simple as this: let's go look at the statement of equity. Let's break down the average share price, and then let's look at where the shares are traded at, and some of the awareness campaigns that are surrounding that.
Absolutely, that's truly why I started the deep dive, and that's really where the name came from. We were diving into all these stupid filings. Or sorry, I guess it was me. It was a one-man team for a year and a half. But the struggle is once you start talking to these companies and you form friendships, and it's it makes it hard to, how do I phrase this appropriately? It makes it more difficult to
throw shade.
to throw shade, because the second that's published, your phone is lighting up. It happens all the time. Summer of 2019, I put out an article. I got so sick, just unrelated. I was literally trying not to puke while my phone is going off the rails, vibrating off my table, with all these different people contacting me, pissed off about this article. And at the end of the day, what were they pissed about? They were pissed because it was right. But that's just the reality of the world, right? And I mean,
I've got some really funny stories I could tell about articles that you've written, where I've been at a family dinner on a Sunday night, and I get a call where one of the deal guys behind it read the article that you or Braden wrote, and here I'm just try to eat some pierogies with my parents and my nieces and nephews and my wife and kids, and it's I just get a call and someone's we woke up the beast.
Or another instance.
Thanks, Jay.
Yeah, I tweeted I was going to look into a capital structure of a company, and all of a sudden your phone's lit up, my phone's lit up, and we're on the phone for 6 hours that day minimum, each of us, with different people, because they're all freaking out. It's if it's so egregious that you're worried about it, maybe consider what you're doing and why you're doing it and who you're actually looking to benefit, because that's at the end of the day why we're writing the content, right?
Yeah. Quickly here, I just want to pull up the little summary from the note from Ian Gillies at Stifel. This is the overall investment thesis. Iguana stands to benefit from the following key items, which help us form our positive view on the stock. 1, residential solar is set to undergo transformational growth globally to support government policy. So in other words,
you read that wrong. Due to supportive government policy.
Yeah. So in other words, with Biden being in the White House, we're probably going to see solar grow. Let's go to point 2. Residential solar is being augmented by improving attachment rates for battery storage. In other words, a lot of people who are getting solar are now realizing, hey, why not have some storage to go with my solar? It makes a lot of sense. I can actually operate my house at night. Point 3, we anticipate rapid revenue and EBITDA growth from these events. Point 4, there is potential for new business lines. So that's when you have the power controls, you can do that. Point 5, the company is a potential takeout candidate. So I think that all those points are very, very interesting, and effectively sums up what I've thought of this company for years. And the funny thing is, I thought that the EBITDA and revenue growth would have came a lot quicker, but there's a lot of supply chain factors here. There's a lot of change that it never happens quite as rapidly as we want, but I feel like we might be on the precipice of all of that taking off over the coming quarters.
Yeah, I mean, anecdotally, I would love. I'm, as pretty well probably everyone knows by now, I'm moving in a couple months here, and I would personally love to get a solar install, but to me it doesn't make sense to have solar without some sort of energy backup, whether that's battery storage so you can actually store it, or you're still hooked up to the grid, because you need to be able to store that energy, otherwise it's pointless, right? At least I see it as pointless, especially in a jurisdiction where they aren't going to sell back or purchase your energy at a decent rate. So that's where I see this really taking off. Is I have a sense that despite stimulus and subsidies put out there by certain administrations, regardless of what side of the border you're on, I think that we'll see these operators start to pay less and less for the energy as more and more comes online, because it's just a simple supply and demand thing. So I think that will also lead to an uptick in battery storage, because people are just going to get mad. Example here in Saskatchewan, I think last year or the year before, they actually cut their program for solar substantially, and they're now looking to just do it on industrial scale rather than is effectively rewarding the people that can afford a solar install by providing them with better rates. So that's where I see the whole battery storage thing come into play. I know you and I haven't really talked about it. I mean, you could have a totally different opinion on it, but that's kind of where I sit with it.
Yeah. So one last thing, well, we're on Iguana. Someone just sent this to me, an article on Q-Cells. So Q-Cells is the partner. So Iguana, they were partnered with Mercedes there. Mercedes decided we want to go after the home energy market, similar to what Tesla does. Now, of course, sometimes what you learn is because it makes sense for Tesla doesn't mean it makes sense for everybody else, because real automotive companies, they don't get those multiples, they don't get that narrative. So they worked for a couple of years there, creating a white labeled battery. They were going to attack Europe alongside Mercedes, which shows you how real of a company this is. Mercedes is no joke. Like this is a real company that's got very sophisticated engineers, and they were interested in working with these guys. So, and part of the strategy, I believe, was that they were going to work with Q-Cells. And Q-Cells is the largest I believe that they're a solar manufacturer, but they also work with a very large network of solar installers, the largest in all of Germany, which is a huge solar market. And Iguana is now putting together, or they've created the Enduro, which is a white labeled battery specifically for the German market. And here's a little article someone just sent me on from Q-Cells. Q-Cells anticipates year like no other for Europe's solar market in 2021. As market leader in many of Europe's main solar markets, Q-Cells expects that 2021 will be a year like no other. Analysis of government policy, assessment of customer feedback, and demand and anticipation of our own product rollout for 2021 leads Q-Cells to predict a memorable year for growth, regrowth, and the arrival of long anticipated leaps in technological performance and quality. So again, we haven't seen a whole lot come out of Germany yet for Iguana. The stuff, again, it takes time. Let me see if I can get a picture here of the Iguana Q-Cells battery. There's one here. You think it would come up when you Google it. I don't see it. What's that?
What did you Google specifically?
The Q-Cells battery with Iguana, because I believe that they got a large. Here it is. This is the Enduro. Can you see that? No, probably not. There we go. So that's the Iguana Q cells. Now this is more of an indoor unit. It's 6.5 kilowatt hours. So this is more of a easy to install unit that goes in the home for, smaller houses in Europe. But it goes to show you, like, this is a company, they're partnering with, we're partnered with Mercedes, Q Cells, Itochu, there's other names too that escape me at the moment. E-Gear out of Hawaii, which is huge. So the point is that you've got a real company that's working with real people and doing real things. And Q Cell saying Europe is going to be a big year for solar. So hopefully we start to see some of that show up in the top line revenue for Iguana. Now, look, we've gone a little bit later today than we normally do, but hey, I'm just happy that my camera hasn't broke down. So give a guy with the small cap a break. All right. Jay, what's going on over at the dive today?
At the dive today, you would think I would have this prepared after doing this for 3 months, but I got it all prepped last night again. So.
I'm sending you a quiet clicking mouse because
I know you've promised that for a while. That's why I haven't ordered it.
I have one right here, but it's holding up all my cords. That's the one thing about this setup I have here. You guys, one day I'm going to show a screenshot of it. It is monitors galore. The worst thing is I don't have a monitor right over top of my camera, which I'm working on it. I ordered one and then I got it. And then it turned out that it was like a DC. So I actually had to have like a battery and stuff. I don't want that. So I had to send that back. But soon I'm going to be able to look at the camera more when I talk, which makes a lot of sense. And again, we're constantly trying to make this stuff better. Anyways, there's a whole side. This has consumed my life for the last 3 days.
Oh, more than the last 3 days. Anyways, so on the daily dive, we've actually got Tavi Costa. I believe he was on SmallCapSteve, was he not?
No, he hasn't been on SmallCapSteve yet.
Oh, my apologies.
This guy's Twitter feed is
outstanding.
It's out. If you like covering macro here, let me pull this up. It'd be funny if I pulled it up and I found out he blocked me. Wait a minute. I don't follow Tavi. He doesn't follow me. That's fine. I'll give him a follow. He has just a lot of very thought-provoking charts that he comes.
Oh, he's on the 24th. Look at that. That's probably what I was thinking of.
Look at that. Le Predicteur. Chris just keeps hitting it out of the park, getting us great guests. I almost fired him on the air yesterday, by the way, but he does a good job. And
so you'd go crawling back if you fired him. Just admit it at this point.
Yeah, I'd be like, how do I turn my camera on again?
Anyways, so Tavi will be discussing a commodity super cycle that may or may not just be starting up. Outside of that, young Justin covers Raymond James on Village Farms, the Eternal Bull. Effectively is what RJ is at this point. Outside of that, right before we went live, Michael Miller actually put out a great article on hiring by MSOs, multi-state operators. He goes through and he tracks it because he loves filings probably just as much, if not more, than ourselves. And great content there. And then we also have Hermina, who covers the $1.9 trillion question: where will Biden's stimulus checks end up? Interestingly enough, right before we went live here, I got an email saying, looking for investment advice for your $1,400 stimulus check? Investment expert available to give tips for new and experienced investors. So you probably know where the answer to that
Maybe
lies.
Is there a number? Can we call them live on the air tomorrow and get investment advice from somebody who's telling you how to allocate your $1,400
to get a massive return?
Yeah.
I'd say something, but I don't want to come off as investment advice.
I'll say it. Download Robinhood. Go buy whatever the shortest dated call options. Is it at the money or out of the money, like far out of the money that you want to try to force the market maker to cover? I don't even know.
Right at the money is my understanding.
Yeah. So that's the thesis.
I'm sure Spot Gamma will see that and go, "No, we thought that's not what we thought, you guys.
We've done 3 videos with you guys, and you still haven't learned." So little disclaimer here: nothing we talk about on the show is intended to be financial advice. I'm not licensed. This guy's not licensed.
Not at all.
Our producer Chris isn't licensed. So none of us are licensed. So, you know, you're watching this. Your decisions are on you, not on us.
We're solely entertainment at best, and I don't even know that we're that.
Yeah. And we've also got Todd Bubba Horowitz coming on, who's an engaging, interesting character. He's going to be coming on Friday. We always got a great guest on Friday. I have to. My wife told me that if I don't spend half an hour on the elliptical today, she's going to beat me with a stick, and I don't think she's joking. So
all she's got to do is take your phone or you know what? All she has to do is cut the internet, and then where do you go?
Oh God! Look,
put it in front of the TV, watch some CNBC. That's what you should do. So here's a little anecdote. Steve calls me the other day. He goes, "Man, my mornings are so wild. I have to lie in bed and watch CNBC for the first 2 hours of every day." Meanwhile, I'm publishing literally 10 to 12 articles every morning.
Oh, well,
so that seems like the perfect time for you to get on your elliptical.
Then that's why I'm the CEO and you're the
the
peasant editor. The peasant editor.
The sidekick, actually.
Yeah, the sidekick. My trusty sidekick, Jay Lutz. So, you know, everybody, you could have spent your last hour staring at any screen, any place in the world, but you chose to spend it with us. I sincerely appreciate that. Every single one of you, from the pumpers to the bashers to the trolls to the fund managers.
You need a Dr. Seuss rhyme for that. You gotta figure it out.
I had one.
I know you tried, but it wasn't coming.
Well, I just don't know how inappropriate I want to get on this show, and that's like all the stuff that goes through my head. I watched Artie Lang Beer League recently, and it kind of screwed me up. Okay, so let's wrap it up. I appreciate everybody who took the time to join us today. We will be back tomorrow covering Canadian small caps. Thank you, everybody.